Private capital is a huge asset class with a lot of diversity, complexity, traditionally very relationship based and reliant on bespoke, unstructured data. So, servicing it and making it work efficiently has been a real challenge. There's been many vendors over the past few years that have brought a variety of solutions, often based on a particular asset class, say like buyout, or on a part of the life cycle. Maybe one begins in the fund administration or the accounting side. Another might begin more in trying to do relationships or in due diligence. Today, with Agentic AI, there's a new breed of fintech startups that are bringing a different approach, combining everything that's been done before and adding agentic on top. It's very ambitious to take the disparate parts of private capital and put it into one solution that is both uniform enough to meet everyone's needs, be understandable, but also flexible enough to address all these bespoke situations. But is agentic AI really the magic bullet that enables a service provider to be all things to all people? I spoke with Katrona Lee, Kat, who is founder of Rubin AI, a brand new fintech that believes the answer is yes. I'm James DiBiasio, and this is my report. Katriona Lee of Rubin AI, welcome to the JDB report.
Great to be here.
Great to have you. You are at the forefront of a huge trend. I mean, private capital in its various forms is, now a leading asset class or group of asset classes that everybody has been interested in for a long time. You're based in the APAC region, and so there's lots of activity amongst GPs and LPs here. Um, and so that sets the scene for how do GPs and LPs do a better job of connecting the deals that they're making and the ideas behind those deals and the sort of the memory of what those deals are all about to the nitty gritty of the operations and the processing, essentially connecting up through data, the records of these things that enables deals to proceed much more smoothly and better. And so just you are a founder, a new founder, a new company in this space. So before I get into it, I would love just to hear a little bit about your story, coming from places like Zero and Thomson Reuters, as well as accounting firms, to give us a sense of why private capital integration and workflows, how that became your obsession and what you're bringing to the space.
Yeah, obsession is a great word for it. I think we all need to be quite passionate to be throwing everything that we've got at
Yes.
being
Yeah.
an operator in this space. And private capital, as you mentioned, is growing massively. Alternative investments is getting a lot of, I think, attention with AI, really just revamping the way we do business every day. So my background has been in management consulting, strategy consulting, and doing transactions for quite a long time now. And so I was in very much the analyst world of grappling with thousands of dot points, I guess, of information about every single kind of sector that I was covering around the companies that we were looking to acquire from a very junior perspective of doing the grunt work of compiling the information to then submit up into investment committees to eventually being in a position where I was fronting those investment committees to say, yeah, we should go and make an investment, or we should go and buy, or we should go and build ourselves. And whatever those judgment calls were, was always based on information that wasn't perfect. And so I think with the advent of lot of these large language models and a more discerning, I guess, customer base because of what technology is able to do nowadays, is this notion that we could make, I guess, decisions and choices better with a more structured perspective all the time. And also, because the economy is changing so quickly, we're in a particularly volatile period right now. I think most people would like to have a more comprehensive perspective before they really like click the button, right,
Yeah.
and
Yes.
invest. And so, from the perspective of GPs, no doubt they want to have a workspace where everything is integrated, where all of their context is seamless, where they can constantly talk to their team members and their key stakeholders, LPs or otherwise, in an integrated system that they always have something to refer back to and can do retros really well. And equally on the LP side, I'm sure that they would rather reporting that's much more dynamic. They know how their money is working for them instead of waiting for that quarterly PDF in an email and not being able to actually go in and dig in and get, they get their hands back on the tools. So there's a lot of different pieces to this, but fundamentally, I think there's an opportunity to really start to bring an infrastructure operating model type of angle to the software and the tools and the capabilities that we use to do our jobs every day.
I think it's kind of remarkable. You mentioned the word structured, how unstructured private capital investing has been and continues to be. Whether you're talking about buyouts or private credit or venture capital or real estate, most of these are relying on unstructured data. Everything's bespoke. It's hugely relationship driven, which is one reason why these industries have been actually quite resistant up until recently to, let's call it fintech, broadly speaking, right? And even the way that they operate is also quite complex compared to, say, a public markets
Mm.
investment stream, right? So waterfalling fees and these things, and just keeping track of all this is really, really hard. So, and at the same time, now we're seeing massive amounts of money, well, for the past really 10, 15 years going into private investments. We're now seeing a lot of fintechs and platforms that have for some time have been trying to broaden the reach of this to new types of investors, family offices, particularly. So definitely a need to try to clean up some of the messes in this space to make it work better. Um, and want to just go back again to your as a founder. Can you give us an example specifically of, you said you've worked on a lot of deals. That's been like your bread and butter. Um, what made you decide to take the leap from continuing to do deals to trying to figure out a way to solve this? Because there's plenty of vendors in this space. This is not, wide open blue sea territory, right? So, what made you decide that you wanted to actually then launch a business that would address some of these issues?
Yeah, for sure. I think there's a couple of angles to it that I feel most passionate about. The first is transparency of how capital is really allocated. As you pointed out, many people kind of refer to the private markets as sort of the Wild West because of the sheer diversification of the private markets. As we talked about earlier, so many different asset classes, so many different fund structures to get things done, and especially in early stage, there's very little information about the potential of a business. So there's a lot more risk involved. And for me, what I'm passionate about is actually giving an opportunity and allocating capital to maybe unexpected innovations. And Australia, really where I'm based at the moment, has always been one that maybe is seen as an underdog market, as a very small retail market, but amazing technologies have come out of it and exported to, various parts of the world and done very well. And so for me, that goes to show that we're at a point in time where capital, I think, can be dispersed even further, can be, funneled towards innovation that might be unexpected at first, but then, results kind of speak for themselves. So for me, first and foremost, why I'm doing it is that technology often enables more meritocracy, more transparency, more governance, more, I guess, equitable distribution of capital and opportunity. So that's really the main mission. The second is, at the end of the day, I think I'm a person through seeing a lot of transactions have seen that just because we think an opportunity looks good on paper doesn't always mean that that's the case in reality. How many acquisitions have we talked about in the fintech space and in other industries that have been really, really exciting? And then the results of that sort of were a bit underwhelming, right? Many acquirers fail to realize the true potential of an acquisition, not because they didn't do, DD to the end,
Right.
nth degree, but because that there are just some things you can't hedge. And part of it is the intelligence capabilities that we have that's accessible for smaller businesses and early stage businesses, but also that there are no capabilities at the moment to see acquisitions, transactions, investments as a living and breathing and continuous journey. It's not just at a point in time when you first make, the investment and transfer the capital, but how can you kind of project out the next 3, 5, 10 years and make good decisions all the way throughout?
Yeah.
And so I got really sort of stuck into this notion of a life cycle product to actually be accountable to your investors, to yourselves, as to why you made the decision in the first place to invest. How do you carry it through? How do you then adjust course as more information, makes itself available, but also as the market's shifting? How do we do that? And so I got really excited about the potential of our technology and combining a lot of different capabilities to build something that's really integrated, that truly allows us to evolve as we go. And, incumbents are pretty static, and that's probably just the limitations of what was available at the time. And now we have an opportunity to really kind of rewrite this industry and what we can do with it.
Let me let me give a quick potted history of technology addressing private capital needs, because from there I think I want to then go into your concept of that life cycle, and how that might work in this new era that we're in. So the first company that's come across my radar that was doing something in this space was eFront, which
Mm,
launched in 1999. So we are going back quite a long way. But they were basically doing accounting. They were a back office accounting admin play using software to address this newfangled asset class in alternative investments. Um, and so I think the important part there is it came from this sort of back office accounting side. And then it was in 2019 acquired by BlackRock and folded
mm,
into their Aladdin portfolio. So that's been super institutionalized. Uh, then in the 20 in the 2010s, we began to see more cloud-based providers that could drill down with more specific needs for different asset classes. So, specific tools for, say, the buyouts versus a VC. So companies like Juniper Square,
mm,
Allview, et cetera, were using the data, and some of them were coming not from the back end but from the relationship side to begin with. And then they would try to go back and make figure out how to connect all the dots. And then most recently, now we've got companies like Affinity that have been using AI and now Agentic AI. So this is the new wave of things. And so this is diving into sort of day-to-day stuff at the front end, like helping with meeting preparations or conversations, remembering what people said, updating this stuff, evaluating deals, and a lot of so it's both the front end and then the reporting and the audit in the back. So that's kind of the way I've seen this space evolving. Now we're in the agentic AI world, um, and so you are doing all the asset classes. You're talking about integrating kind of a front to back, full end-to-end system. So does AI enable a true holistic, one-stop shop vendor solution for private capital workflows? Or are you going to have to start to make choices like these other players have done in terms of focusing on where do you begin, which part of that life cycle do you kind of have to land and make your own first, or a particular asset class, or some other way of considering where it is. So the specifics versus that broad. I mean, how do you think about that? And what does AI or agentic AI allow that maybe we couldn't do before?
Yeah, I guess so. Firstly, I think we should step back and look at the actual structure of the private markets and how deals are done. Luckily for us, in general, although there's not a full kind of published school of thought on how investments are done, there's almost a well accepted sort of value chain that most investors sort of lock into, right? You've got the research piece, you've got the origination, you've got the pipeline development. As you pointed out, there's a relationship component, there's the documents and deal room, then there's the investment committee decision-making process, there's the provenance and actually capturing those decisions and doing governance and reporting on it. And so, all of that enables you to do diligence at the right moments in time to kind of go, okay, do we triage? And once we've triaged and shortlisted the opportunities that we find are going to be exciting for our investors, and therefore exciting for us to move forward with, then so on and so forth. And so because that structure is predominantly accepted by a majority of investors in this ecosystem, it becomes quite clear that the architecture of the platform and the ecosystem needs to map to this life cycle of value chain of activities. And then from there, sort of level up, which is then thinking about, well, how many asset classes do we serve? Where in the market are we going to start first? Where's the beachhead, and how do we kind of expand from there? So with the accessibility now of large language models and them being much more, I guess, affordable, allows us to do things much more quickly, but not to say that we skip the steps, right? At the end of the day, I think is about understanding the structure of the market really well, and then going, is it worth it to build horizontal and then deeply vertical? And so, incumbents have taken different slices because development time used to take such a long time to get deep enough to be commercially viable. Now with that same time frame, we can go horizontal and then deep at the same time.
Wow.
And so that's the choice I've made, is to firstly actually build a product for the first time that's truly very fit for purpose for that full life cycle, and then we pick the components that allow us to deepen first. And for my business, Ruben, we elected to do the intelligence piece first, enabling real-time diligence, really going deep on what it means to invest in a specific asset class and what that means for your investment strategy as a fund manager representing your LPs.
Mm-hmm.
That's the first piece. And then, of course, there's the governance and jurisdictional elements, which is, okay, now that I know what I'm investing in, what's the structure? What's the vehicle? What are the kind of elements that's going to get me the most benefit? What tax elements and configurations should I be thinking about, and how do I bring the best investors and the right investors to help me support that vision? So that's kind of how we've looked at the problem, and it's definitely technology and market timing that's allowed us this incredible opportunity to look at the whole of the ecosystem differently, and being asset class and the asset first, then thinking about the custodians of that asset over time as a secondary problem.
What is the configuration internally at Ruben AI in terms of, I guess, people versus the AIs? Because you're managing many asset classes, many processes, and many counterparties or clients. So, um, how much of that expertise for all of those different components that you so clearly outlined, do you need to have people who are also sort of on top of those things and building, or programmers are developing for those, or are you at a point where there's a few core things where you need the humans to oversee it, but the AI can kind of drive a lot of the work, and so you have a human light. So just curious about how you sort of govern it, both in terms of your team, your human team, as well as with the agents.
Yeah, I mean, to be honest, it is iteratively intersecting, let's put it that way. But first and foremost, it was very much the talent first, domain expertise, driving what the product roadmap should look like. And then first hire, of course, was product management over developers. And that was a priority that, I had learned from let's say, past experience career wise, but also observing early stage businesses where they threw a lot at the technology and not understand what the actual use cases to solve for and what the problems really were.
Yeah.
And so it was important to really download almost the architectural blueprint of what it needed to be built and what was the most urgent pain point in that structure, in that value chain, and then go hard at the product after that. So we kind of did it in almost alternating fashion to go, okay, well, if we know that the end state is a fully end-to-end, you know, basically an asset class mapping of the entire private capital market, then we need to make sure that our architecture has the ability to be really dynamic rather than fixed and very siloed. And because of that, we're able to sort of download that initial sort of set of drawings first, build
Right.
and iterate from that perspective. So I would, to answer your question, domain experts first and then development second. But a lot of that AI work had to be harnessed because we had to be, very clear on what it was that we needed to build initially.
When you're working with LLMs in such, critical points of workflow processing, um, how repeatable are they? So if you use a classical computer program, something old-fashioned, it's it's programmed. You do this, and then you have a decision, and then A, B, or C, and then it flows through. Um, and you can also go back and look at the code in case there's ever something that doesn't flow the way you think it's supposed to. With LLMs, they don't work that way. Um, and if I prompt something, this is a maybe a very amateur question, but if I prompt something and then I prompted more or less the same thing again, I can get a very different answer, right? So
Yeah.
how how does it work in terms of making sure that as you're building kind of this new AI-based infrastructure to handle all these different things that your domain experts have blueprinted, um, how do you make sure that results are um, repeatable or when they need to be, as opposed to being always bespoke or flexible for a particular situation?
Yeah, I love this question because you call it old school, but I think that is sort of a very classical, like you said, way of governing data integrity. And so we actually take a lot of those principles and apply it to Ruben today. So we definitely structure instructions as a series of issue trees and decision trees, right? So the scope for filling in the blanks is very, very small. And we use an algorithmic approach to make sure that any normalization, any risks, any exposure is all explainable, quite analytical in the way that we do things. So if we think about a particular asset class, we'll kind of go and interview a range of fund managers. Say for our venture capital asset class products, we spoke to 100 fund managers and said, okay, what are the things that you care about, right? It's market, the integrity of the market, the growth of the markets, traction is less important than founder quality at very early stages, pre Series A, for example. So these are all things that we made sure were codified into how we thought about what a great opportunity looked like versus a good opportunity. And instead of quantifying it, we sort of did it like investment bankers would to go, what's the probability of something being great versus good relative to each other, rather than a score that maybe an AI agent or a
Right.
model just sort of, a spread. So we put so much structure into it so that it wouldn't have too much room to make stuff up. And of course, we have a whole bunch of other protocols in place to make sure that everything that is derived from the market or derived from, internally supported information like documents, pitch decks, income statements from a company, they're all sourced and citable. So there's never any very, very little room. Of course, there's always a margin of error, but very, very little room for an AI agent, for example, to fill in the gaps
Yeah.
without any real parameters. Yeah.
And who owns that data record? Is it the GP, the administrator, the LP, you? I mean, where's the ownership and I guess the liability?
Yeah, so all of the data that is generated off the back of inputs of a fund manager and their portfolio is the data and it belongs to that fund. And however they've structured their portfolio rolls up to their organizational vault. And that vault is always the lock and key, of course, is available to the GP and their team at any given time. And we only have really back end access, right, to provide support. But yeah, and that's kind of how we air gap every single component in every single organization to make sure that there's no risk of data ever flowing. And one of the sort of key questions we always get from GPs is, oh, well, if you are aggregating um, our data to train your models, how would that work? Well, we don't, right? We don't aggregate deal data or proprietary information from a fund strategy into the training of the models themselves. What we do instead is we look at the behaviors of what's driving engagement to make the product much more seamless, much more intuitive, and just a much more lovely experience to
Right.
use. And so that's quite a big distinction there.
So you sort
Um,
of made cat, you kind of made the decision not to aggregate that data and then create a new product on top of that.
that's it.
Right. Okay. Because you don't want to lose the trust of your clients.
Yeah, I mean, that's our biggest risk, right? If at any given point in time, an organization says to us, hey, it doesn't look right. I can see somebody else's data, or I'm seeing an opportunity that I'm not consented to either receive or to share with the wider network. That's something that's like the worst case scenario
Yeah.
for us. So first and foremost, just making sure that that structure is there and we gain the trust and have the resilience in place to make sure that there's no real room for that to happen.
How does provenance work? Because I talk to a lot of companies in the crypto or the DLT space, and I think
Mhm.
provenance is one of the true use cases of blockchain. It's not fit for everything, but I think it's a use case that goes well beyond crypto and trading and all that stuff. Um, how does it work in your world? What are these technologies doing that give you assurance that provenance is established and people can look at that and say, okay, I believe that this data point links to this,
Mhm.
and then you can use that throughout the life cycle of a fund.
Yeah, so I define provenance in our worlds as a composite of three key characteristics or key three pillars. The first is coherence. So what you do in this part of the platform must sync up to all of the downstream activities, right? So if, for example, you set up, very, very simple example, you have a portfolio of lots of different fund structures and jurisdictions and currencies, how you want to report, for example, versus how you actually do your internal tracking might be different. And so we're going to lose credibility quite quickly if in one part of the platform it says USD, another part of the platform it says something else. So that's a very simple example of broken trust and broken provenance, and lack of coherence in data that supposedly flows all the way through the life cycle of the platform. So that's one key aspect. The second, of course, is traceability. At every given point in time, you need to be able to go, okay, well, if you've said that this opportunity is exciting relative to somebody else, why is that? There has to be evidence for citing and making that judgment call. We don't, obviously with caveats, don't actually act as a financial advisor, but we provide a lot of the information base for fund managers to make really great decisions, right? And so that needs to be something that they can kind of go, oh, I can see the credibility behind it. I can see the sources that they've cited, and they've triangulated a number of sources in order to kind of provide me this data point or this insight. That's the second piece. And then the third piece is visibility. At every given point in time, the right information needs to be available for you to take the next best action. And so I think that's where incumbents are starting to potentially lose market share, is that they don't have the technology and the access to the latest tech to be able to go, okay, well, if the world is dynamic and therefore the information is dynamic, how do I make sure that I'm surfacing in the right moments the right next step for the user to take? And I think that sort of visibility is quite important, because yeah, if you can't find the information you need, then you just assume that it doesn't exist or it's incorrect.
Right.
And so
So
to
is it,
me that
yeah.
happens, yeah.
So is that the point where you're trying to provide something that goes beyond just optimizing workflows to creating new insights or new types of information that GPs can use?
That's it, exactly. I think the power of a platform like ours is the ability to actually challenge and improve and iterate and help you kind of evolve your portfolio. We talked earlier in the piece about diversification and the need to in opposition sort of corral and converge things to make life easier, and to do things faster. But efficiency and focus don't have to be opposing things. I think technology has allowed us to get quite good at hyper personalization at scale and really tailor the experience for the specific use cases and the challenges that each, you know, person or entity in this ecosystem is facing. And so, yeah, for that reason, provenance is really, really important. Visibility, traceability, and the confidence that your information is safe and that it's always going to be accessible. And then from there, you can kind of go, okay, well, what can I do differently or better the next time around?
Kat, thank you for your time. Last question is about the business itself and your own financials. So, when did you launch it? Where are you at the stage in terms of getting users and clients? Obviously, it's a sort of a SaaS structure, but I guess you also have some customizable options for clients. So maybe give us a sense of where the business is. Is it more the SaaS? Here's the model, use it, or if you're being asked to build a lot of extra bells and whistles, and then your funding. Where are you at, and what's that runway look like?
Yeah, sure. So we launched commercially at the end of April this year. So, it's
Congratulations.
been very fast. Thank you. So we've been, alive just over a quarter, which has been fantastic and exciting. So in terms of uses, we have two go-to-market motions. We have our direct business, our self-onboarded, self-serve customers. We have about 200 as of last week. I think about 250 fund managers on our platform and deal teams from around the world. Really interesting to see a significant amount of them coming from Europe and North America, as well as the APAC region more broadly, outside of Australia. And then we also have our enterprise offering with an initial focus on family office and family office networks for complex multi-asset allocators that are a little bit underserved by the technology that's available right now. So yeah, the way we price and monetize really is a combination of utilization and of course a baseline sort of platform capability that's available. So we want to be reflective of how capital markets work, where decisions are made in a cyclical fashion, and sometimes you are harvesting and sometimes you're fundraising and sometimes you're deep in diligence mode. And so the way our platform works is very, very much reflective of which of the activities are overwhelmingly consuming the attention of the deal team at any given time. And so our monetization model maps to that.
Yeah. And how dependent are you on the fact that a lot of the LLMs and these agentics they're being subsidized essentially by the big Silicon Valley firms right now? At some point, we expect those costs for token usage to go up. Is that something that you can bake into your, do you have any way to sort of mitigate that possibility?
Yeah, for sure. We really structured the business to be model agnostic and jurisdictionally agnostic. So, users can select which models they prefer to use or use our defaults, and we often select the best models for a capability at any given point in time. So, I think going forward, we could definitely decouple model selection from our tool and our capability itself and offer a bundled approach or a decoupled version where a fund manager or an investment firm brings their own, token usage and their own token budget and marry that up with the platform. So, we're sort of seeing a bunch of different options and opportunities coming up, and it's something that we're definitely iterating and experimenting with.
Great. And what's your own funding situation right now? Are you self-bootstrapped? Do you have VCs behind you, or how's that model for you?
Yeah, so we did a friends and family round earlier this year in place of a pre-seed. I'm expecting to raise institutional capital probably later this year, early next year. But for now, we're trying to just get as far as possible before any real external funding.
Great. Okay. Well, good luck with that, and thank you again for joining me on the JDB report.
Really appreciate it. Thanks for having me.